We all know that bear markets are going to happen, right? That's a given. But being ready for them, well, that's a choice. So today, we're going to dive into two really powerful strategies you can use to not just survive all that volatility, but maybe even come out ahead. You know, this question really cuts to the chase, doesn't it? It gets right to the heart of the problem for any long-term investor. It's this constant tug of war, that amazing feeling of watching your portfolio grow versus that pit in your stomach, that fear of seeing it all disappear in the next downturn. It really forces you to be honest with yourself about risk. So let's kick things off by digging into the incredible power of long-term stock market investing and, of course, the massive gut-wrenching risk that comes right along with it. This is really the core of the problem we're trying to solve here. And wow, this really shows you the two sides of that coin, doesn't it? On the left, that's the dream, that spectacular long-term wealth-building engine that is the stock market. It's why we're all here. But on the right, that's the nightmare, those brutal, steep drops that feel absolutely catastrophic when you're in the middle of them. Negative 83.46%. Just let that number sink in for a second. That's the single biggest drop the S&P 500 has ever had from its peak. I mean, can you imagine watching more than 4/5 of your portfolio's value just evaporate? For most people, that's not just a loss. That's game over. And this is where the math gets really, really painful. When you fall into a deep financial hole, you don't just have to climb back to where you started, you have to scale a mountain just to get back to even. The deeper that loss, the exponentially harder and longer that climb back becomes. We're talking years, maybe even decades.
Okay, so you might be thinking, well, what about diversification? Isn't that supposed to protect me? Well, let's talk about that because even the most common advice we hear can fall short right when you need it the most.
You see, in huge downturns like the 2008 financial crisis, things that are supposed to act differently, like real estate and foreign stocks, all crash together. And then, get this, in 2022, something even weirder happened. Both stocks and bonds, your classic safe haven, went into a bear market at the exact same time. There was basically nowhere to hide. You know, the famed economist Mohamed El-Erian just nailed this reality after the 2008 crisis. He said, diversification alone is no longer sufficient to temper risk. The bottom line here is crystal clear. Just having a simple mix of stuff isn't good enough anymore. You need more tools in your toolkit. So that brings us to our first potential solution. And this is a really interesting one. It's a simple mechanical rule, not based on emotion, not based on guesswork, but designed to systematically help you sidestep the worst parts of a bear market. The strategy is called trend following, and the idea is actually super simple. Instead of trying to predict the future, you just react to what the market is already doing. You're just going with the flow. You buy when there's an established uptrend, and you sell when there's an established downtrend. So check this out. It's actually way simpler than it sounds. The blue line is the price of the S&P 500. And that red line, that's its 10-month average. It just smooths out all the day-to-day noise. The rule is dead simple. When the price is above its long-term trend, you stay in the market. When it drops below, you get out and move to the safety of cash. That's it. And the difference from following that simple rule, well, it's just night and day. On the left, you've got those terrifying deep drops of a buy and hold strategy. On the right, using the timing model, hey, there are still losses. No strategy is perfect, right? But look at how much shallower they are. Historically, this kind of approach has helped investors avoid the absolute worst of the damage. And when you look at the actual numbers, over more than 100 years of data, the story gets even better. The model didn't just give you slightly better returns. More importantly, it dramatically cut the volatility, all those gut-wrenching ups and downs. And it slashed that worst-case loss from that devastating 83% all the way down to a much more manageable 50%. That is a huge, huge difference. Okay, so that's strategy number one. Now let's talk about a second approach that works right alongside it. This one is less about trying to time the market and more about building a strong foundation for your portfolio, preparing it for the storm before the clouds even start to gather. I love this analogy because it just perfectly captures the idea. You don't build your house out of straw and then frantically try to upgrade it to brick when the hurricane warning is already blaring, right? No! You design the house to withstand the storm from day one, and it's the exact same idea for your portfolio. And trust me, history shows us these storms are not some kind of rare, once-in-a-lifetime thing. They're a normal, rhythmic part of investing. The market drops more than 10% about every year and a half. A full-blown 20% bear market? That happens every 4 or 5 years. These aren't surprises, they're just part of the deal.
You know, what really matters isn't just how far you fall, it's about how long it takes to get back up. On average, the market takes about 3 years to hit a new high. But if that drop happens during a recession, that recovery can stretch out to 6 years or even more. And that is a very long time to wait, especially if you need to pull money from your portfolio to live on.
So, how do you figure out how much you might need? Well, there's a pretty simple 2-step way to think about it. First, calculate your income gap. That's the amount of money you need to sell from your portfolio each year to cover your expenses. Then you just multiply that gap by the number of years you want to be protected. So for example, if you need $50,000 a year from your portfolio and you want a 3-year buffer, you need $150,000 in dry powder. That's the cash that lets you ride out the storm without being forced to sell at the worst possible time. All right, let's bring this all together. Let's look at how these two big ideas, timing and preparation, can combine to completely transform an investor's mindset from one of fear to one of power. You see, at the end of the day, both of these strategies we've talked about lead to the same powerful destination, having dry powder. It doesn't matter if you get that cash reserve from a timing signal or from building it into your portfolio structure from the beginning. The result is the same. You've got the resources to act rationally when everyone else is panicking. And this is how you completely flip the script. With dry powder, a market crash is no longer just a threat to your wealth, it becomes a strategic opportunity. You have the cash on hand to rebalance your portfolio and buy high-quality investments when they're on a massive sale. So I'll just leave you with this final thought. It's really a challenge to look at your own strategy and ask yourself honestly, is my portfolio just built for the average sunny day, or is it truly built to withstand the storm that we all know is eventually coming?